Hey guys, good afternoon. This is Murli from SMS. Today we're going to talk about how to make money or how to be successful using seven-step strategy, seven steps trading strategy. So the I'm going to give you how it started so that you'll understand the value of it. Okay, so it's actually one of my mentors, one of my mentors actually came up with this framework, and his name is William O'Neill, and he actually sorted to sifted through hundreds and thousands of these shares. Like it started with US market. In US market, he went through all these stocks which actually went which gave 2,000%, 3,000%, enormous results, enormous returns, right? So it just took off. So his idea is like before these stocks took off, before they actually gave this kind of returns, what are the patterns, what are the common denominators, right? So he laid it out like every stock went through the patterns, he went through everything and then laid it out and came up with the uh, seven things which actually lie across all these stocks. What are those seven uh, factors which actually are common in these most successful, uber successful stocks across the market? And this is actually validated in other markets as well, like Japanese market and things like that. So it's basically the fundamentals are like universal. It's not specific to any market. So what is this seven-step investment strategy? So there is an acronym. It's called CAN SLIM. Okay, let's speed it up and then start going through that. So having said that, what CAN SLIM is like C, for example, the first one is C. C means current earnings. You have to understand. You have to see what the current earnings are for this company. So how are they doing? Current earnings, right? Are they growing? Current quarterly earnings, are they growing? How are they doing? You have to understand that. You have to see that, right? So typically, current earnings should be 20%. Again, the numbers you can check. It's not, there's no hard and fast rule, but it gives you a good ballpark. Typically, like these uber successful stocks, before they take off, they show 20% consistent increase in their current earnings, right? Fair enough. And then the second thing is A, is annual earnings. So you actually should see for the last 3 years, you should see annual earnings are increasing for this company consistently. Last 3 years, every year they actually raised by 20%, 25%, like 15, 20%, 18%, whatever, right? But they consistently raise that. The reason we actually see both current earnings and annual earnings is that if there is any discrepancies, right? Like annual earnings, they're making it, but current earnings, they're not, or current earnings, they're making it because it is at a certain quarter, they have certain things coming up, they're doing some bookkeeping, whatever, but it won't show up, the same returns won't show up in your annual earnings. So both these together will reduce, like picking up a laggard stock, what I call, right? The next one, can N, is new management or new products. So what it is if you're looking at, see, why would anything like which is uh, trading, let's say around like 10 rupees, right? Why would it become 100 rupees? Because there is a new product they're launching, because there is new management, there's a new CEO, there is a new COO, whatever, right? There's a new management, new executive board, or there's a new products that they're about to launch, new service, or the new market is coming up that they're penetrating, things like that. uh, they're catching up with their base user level, and then they're going to the next level, whatever. But you need to understand that what is that, like that's it. That's the end part of it, management, new products, new services, things like that. Yeah. The next one is S. Okay, in canceling, S is supply demand. So you need to see that like there should be enough or a bigger supply of these shares. You can't get into something which is very small, and so that like when others are coming in, when others are buying in, because the reason is like, okay, you're buying in a stock at 10 rupees, right? And you want it to become 100 rupees. It will become 100 rupees when others buy, when other institutions start buying this stock. That's when it becomes high. So you need to, that volume should be bigger, right? Now that actually we'll talk about volume, how it plays an important role in the next one. So after S, it's like L, okay, leadership. So what it means is, see, any company has a leadership position. Okay, it's called first movers advantage. Let's say this company is doing something in this market. So is it the first mover? Is it a laggard or a leader in this market? Is this company actually like is a first mover, and then typically 80% of the market share of that segment is held by first mover. Look at anybody, any company, any segment, and then the others actually fight for the change, right? So are these the first movers in that segment? You need to see that, because that will actually show that, I mean, that's going to really take off, right? Then comes institutional ownership, institutional investing. Always understand, okay, these institutional investors are smarter than you, right? Like they have more resources than you. So if they are buying certain things, right, that means there is some value in it that you need to understand, provided all the other things will fall into place. If you see that some institution is buying, and the other thing is, if one institution is buying, let's say you buy a stock at 100 rupees because some institution has bought, there are other institutions which actually sees this institution, not you though, right? This institution has bought this, starts buying that, right? So when more people are buying, then your stock goes up. It goes up to 20. You take your returns, you walk away. Simple, right? So how do you know these institutions are buying something? Look at volume. Okay, every day any day you're looking at a stock, you look at both price and volume. Volume is very important. Let's say the volume of a share is like 10,000, 100,000 average every day. And if you see the chunks, right, like at certain chunks, like somebody bought like 400,000, right? So that means these institutions are buying, okay? So these bigger chunks are only going to come in when these institutions are coming. So you look at the volume to understand this, that they are the people who are buying, right? The last piece of the puzzle is market direction. No matter how good the share is, how good your particular company is, if the market is going down, guys, it's going to fucking go down. Okay, you need to understand, have a pulse on the market direction and the general market direction, of course, because either it's going up, it's going down, right? So typically buy in when the market direction is up. Don't be chivalrous and say that like, hey, my stock is super good, it's going to make money, right? Typically, right, try to buy, follow the market direction, right? So and there are like the market technicals, and there are certain indicators, certain fundamental indicators that you can look at to see what the market direction is. So that's it, guys. So we have this can slim. You look at current earnings, you look at annual earnings raised like over 3 years, and is there any new management, new products, new services. Then you have supply demand. Are there enough shares that other people can buy? Then is this stock, or is this company is a laggard or a leader in the market? You see what I'm saying? Then are there any institutions which are buying? Is the volume high? Suddenly it got higher. You have to look at that. And what is the market direction? So follow this, look at all these seven, and pick your stocks. So where this fits in is in your buy strategy. How do you pick a stock? I mean, what is that you need to analyze? What are the factors you need to look at when you're buying a stock? That's where it comes in. I hope you learned from something from this. Have a great trading, guys. Thanks. Bye.